My name is Jason Dufrene, and my project is on firm analysis. The objective is to analyze two industries, 5 different firms, choose the best firm in each industry, and then compare the top 2 firms and decide which industry is the best to invest in. I'll be analyzing based on the following criteria of ROE, or your return on equity, your price to earnings ratio, market to book, and economic value added. The first industry and why. The first industry I chose was the fast food industry because there are many different restaurants with different styles, types of food, and many choices, which all shows preference. And my why is to find out which restaurant sells their product and which need debt to stay running. The five firms are McDonald's, Wendy's, Papa John's, Panera Bread, and Popeyes. The first analysis is your ROE, or the return on equity. Based on average alone, you can tell Popeyes has the best ROE with 133% average. But we don't always want to look at averages, we want to look at trends. Because you can see Popeyes had the highest at one point and then it had drastic drop the whole way down. The best 2 ROEs are Panera Bread and Papa John's. They both increase over the 5 years on a very consistent trend. The best ROE, I would say, would be Panera Bread. This is because they have the highest, most consistent upward trending ROE. They start at 15.8% and they end at 25.8%. ROE is still not the best indicator because it can be broken down into 5 parts. The 5 parts are tax burden, interest burden, operating margin, total asset turnover, and equity multiplier. Their tax burden, they're paying high taxes of 62%, which means they're bringing in more money. Their interest burden is very low, which is concerning. Their operating margin they have the highest operating margin, meaning they are earning more profits for every dollar in sales. Their total asset turnover is the highest, meaning they're selling their assets quickly, and their equity multiplier is rising. This means they're funding assets with more debt than equity, which is also concerning. The concerns are, with the low interest burden, they're not utilizing debt or cheaper money. Their leverage magnifies gains and also magnifies losses. And in this case, it would be a gain because they have a high total asset turnover, meaning they're selling their products and generating cash flows. With more leverage, they'd be able to buy, produce, and sell more products and make more money. The rising equity multiplier is also concerning because you need to have a good balance between equity and debt funding your assets. This is so you can use cheaper money to fund your assets instead of using all your equity. Next ratio is the price to earnings. This measures future cash flows based on historical data. This is the reason to invest, to generate future cash flows and measure future growth, to see if this is worth investing in or not, and measuring and comparing the good to the bad companies. The price to earning comparison, all except Wendy's are consistent. Wendy's goes very high and drops it's very inconsistent. Popeyes has the most rising and consistent price to earnings, and Panera Bread is also consistent. They both end at 26, meaning for every $1 they made last year, they're expecting to increase by $26. The next ratio is the market to book ratio. This is the amount of cash generated by a firm for every $1 put in by shareholders. Firms should generate as much cash as possible in order to be most efficient with shareholder investments. So when we compare the market to book, you can see Popeyes seemed to be doing the best in 2009, but had the greatest drop of trends. And Papa John's is trending the most upward. Panera Bread is staying consistent, and Wendy's is the lowest. So Wendy's has been lowest for every category. Next is the economic value added, which best measure of profitability. It's your NOPAT, or your net operating profit after taxes, minus your cost of capital. This shows how much the firm has made, minus how much how much it costs to run the firm. It's important to see if the company has met the demand of the shareholder to see how much the money is worth. This is the perfect example to measure why trends are better than averages. Average, you can tell McDonald's has the most out of the whole industry, and every other firm is a very small portion. But when you look at trends, you can see that McDonald's has been very inconsistent and volatile, rising upward until 2011 and downward there on out. Panera Bread has constantly risen from 2009 to 2013, and they've been the most consistent through it all. The best fast food firm, after analyzing ROE, price to earnings, market to book, and economic value added, consistency in increasing is the most important to shareholders. They want to have their money in a firm that will constantly increase or stay the same and not decrease. Panera Bread had the most rising ROE, consistent price to earnings ratio, and market to book, and a rising economic value added. That's why Panera Bread is the best firm of this industry. Industry number 2, and why. The second industry I've chosen are department stores. The reason I chose department stores is because I believe they'll have a high asset turnover based on the amount of products they sell. They sell clothing, tools, appliances, TVs, and many other products. And I believe with this high volume of products, they must sell it quickly. And the 5 stores are Macy's, Dillard's, Sears, JCPenney, and Belk. Analysis. The first, I'll be using average ROE. You can see that there are only 2 firms with high averages, and Macy's is the only other one that's barely above even. And Dillard's and Belk are the 2 best. The other 2 are negative, which is not a good sign. ROE trends are a better indicator, and all companies are very volatile, and none give a good indication of success. Instead of trying to decipher through this mess, I just picked the 2 best firms and graph their trends. The 2 best firms are Macy's and Belk. Macy's starts from the lowest point of negative 60%, and they've had the largest increase between 2009 and 2010, which brings them to their highest point of 22%, which is higher than Belk, and they're both on a rising trend from their starting point to the ending of 2009 to 2013. I broke down Macy's because they had the highest ROE, and their tax burden, they're consistently at 64%, meaning they're bringing in more money. Their interest burden, they're rising interest burden, which means they're burdened because they're taking on more debt. Their operating margin is rising, which means they're increasing profit from sales. Their total asset turnover is volatile but fairly consistent. It's not the greatest. And equity multiplier is all above 1. It's consistent, but that means they're funding more assets with equity instead of debt. Macy's has a rising interest burden and a high equity multiplier, which means they're paying less interest but funding more assets with equity. They're not taking advantage of cheaper money, but the one ratio that does set Macy's apart from the rest is the operating margin. For every $1 in sales, they're making the most in operating profit. Macy's starts with the highest in 2009 and continues to rise above the competition, ending at 9.6% in 2013, which is higher than every other industry firm. Next is their total asset turnover. I anticipated a high total asset turnover based on the amount of products the store sells. I chose the 3 with the highest firms with the highest total asset turnover, which are Dillard's, Sears, and Belk. And none of them had the turnover like I expected. They all seem to be, compared to the fast food industry, they were all higher. But Dillard, meaning for every $1 in assets, firms brought in more sales. Sears had the highest total asset turnover, and they rose consistently between 2011 and 2013, and the rest have still maintained consistency as well. The final part of ROE is your equity multiplier. Sears had the best equity multiplier, and throughout the 5 years, Sears has had the only one that has risen. Macy's has remained consistent, fairly consistent, and their assets are being funded more by equity than debt. Looking at interest burden of Macy's, it is rising, which means they're taking on more debt. And that makes for a good balance between equity and debt funding their assets, which is taking more advantage of cheaper money. So the firm with the best ROE, after breaking down and comparing, Macy's is the best. They are using leverage to magnify their gains, and they have a good balance between debt and equity. They're increasing their total asset turnover and their equity multiplier, which is also good. Their price to earnings ratio. Sears, as you can see, has the highest and the most consistent upward trend. But in 2011, they stopped either showing or giving a price to earnings ratio, which is not a very good indication of the company. It's hard to tell, but Macy's has had the next best, most consistent upward trend. The other companies are moving up and down the axis, or just have a strict downward trend, which shows very inconsistent and not good for shareholders. Next is the market to book, which measures a company using shareholder money more efficiently and consistently. Macy's is on a large upward trend in the blue. Dillard's and Belk are also moving upward, but not as consistent as Macy's. And Macy's has the highest market to book, with earning shareholders $2.50 for every $1 put up. Last is the economic value added, and surprisingly there are only 3 firms with economic value ending positive. They all start negative in 2009 and begin to gradually move up, but JCPenney's and Dillard's just don't have a great economic value added. Macy's shows the only sign of improvement from 2011 to 2013, ending with the highest out of all 5 firms. Macy's showing improvement is important because it shows how much they're making compared to how much it costs. If they have a negative economic value added, it shows the money is costing more than what it's worth, and there's no way a firm can be profitable with a negative economic value added. So after analyzing these ratios, I've chosen the best department store based on the ROE, price to earnings, market to book, and economic value added. Macy's is bringing in the most money for shareholders and having the highest ROE. The operating margin is the highest, profiting more. They may not have the best price to earnings, but they're consistent. They have the only rising market to book ratio, and their economic value added is the only firm that is not negative, and they are the only firm whose income is increasing greater than what shareholders are expecting. The final comparison is the 2 top firms from one from each industry, and I'm going to choose which firm is the best to invest in. These 2 firms are Panera Bread and Macy's, and I will be comparing using the same 4 ratios of ROE, price to earnings, market to book, and economic value added. Their ROE. By comparing on ROE alone, Panera Bread has had the highest, most consistent. Macy's started at negative almost 60%, and Panera Bread has always been above 0, only rising, and even though Macy's has risen the most, Panera Bread still ends and has remained more consistent, which is a good sign. Next is the price to earnings, and although Macy's has been more consistent, Panera Bread has always had a higher price to earnings. They did drop between 2011 and 2012, and in 2013 they remained constant, but throughout all 5 years they've been higher than Macy's, which is more appealing to shareholders. Their market to book, again, Macy's has the more consistent and rising market to book. However, in 2012, Panera Bread is back on an upward trend from their one drop, and they're consistently rising again, showing that they're going to stay on an upward trend. And lastly is the economic value added. Panera Bread has had the better, more appealing economic value added, only rising from 2009 to 2013. Macy's has been very volatile, starting still below 0 and dropping to almost negative 1,700%. And Panera only starts at 26 and ends at 133, which shows a very upward trend. And in conclusion, based on the information I've presented, you can see that there is much more to companies than just the net income a firm brings in. There are plenty of ratios, trends, and comparisons that need to be made when making a decision to invest. Out of the 10 firms in the 2 different industries, it is clear to see why Panera Bread would be the best investment choice. They maximize utility to shareholders in both dividends and estimated future growth, and this is the main reason to invest. And hopefully they continue to rise and give more wealth and happiness. Thank you.